Maya thought she was doing everything right. She saved consistently, avoided unnecessary spending, and kept her emergency fund in a traditional savings account, because that's what financially responsible people are supposed to do. Jordan believed he was even smarter. He moved his money into a high-yield savings account, paying more than 10 times the national average. For the first time, he felt like he had finally beaten the system. But neither of them realized the same uncomfortable truth. Their bank was still making far more money with their cash than they were. While Maya earned barely enough interest to buy lunch each month, her bank used her deposits to issue credit cards, auto loans, and mortgages at rates many times higher. Jordan earned more, but the system itself never changed. The bank simply gave him a slightly larger piece while keeping the biggest share for itself. And that raises a dangerous question most people never ask. If your money is constantly working for someone else harder than it's working for you, are you really saving? Or are you quietly financing a machine designed to profit from your ignorance? For decades, people have been taught that putting money into a traditional savings account is the responsible thing to do. It feels safe, stable, and mature. You work hard, save consistently, and trust the bank to protect your future. But very few people stop to ask what that protection is actually costing them. Today, the average savings account pays around 0.38 fund trum APY. That means if you leave $20,000 sitting in the bank for an entire year, you earn roughly $76 before taxes, not per month, per year. Meanwhile, inflation quietly reduces the purchasing power of that same money every single day. The truth is, your money is not sitting still in a vault waiting for you. The bank immediately puts it to work. It lends it out, invests it, and earns far more from your deposit than you ever will. The system was never designed to maximize your wealth first. It was designed to maximize the bank's profit while giving you just enough interest to feel financially responsible. And that's the illusion. People believe they are protecting their future, while slowly losing financial ground without even realizing. Most people think banks make money by holding your cash safely, but that's not the real business model. Banks make money by turning your deposits into loans and investments that generate far higher returns than the tiny interest they pay you. The moment your paycheck hits your savings account, that money starts working just not for you. A bank can pay you less than 1 fund trum on your savings while lending that same money to someone else through credit cards, charging over 21 fund trum interest. They use deposits to fund auto loans, mortgages, personal loans, and even short-term Treasury trades that earn stable returns backed by the government. The difference between what the bank earns and what it pays you is called the net interest margin. In simple terms, it's the spread between your reward and their profit. And that spread is the foundation of modern banking. The shocking part is not that banks do this, they are businesses after all. The shocking part is how few people understand the scale of it. Your bank can earn multiples of what you receive using your own money while you feel grateful for a few dollars of monthly interest. And once you realize that, your savings account starts looking very different. It stops feeling like a tool designed to build your wealth and starts looking more like a system where your money becomes fuel for someone else's profits first. Most people believe banks make money mainly from loans, but the reality is far more complex. Modern banking is built on layers of invisible profits that most customers never notice. Overdraft fees alone generate billions of dollars every year, often hitting the people who can least afford them. Every time you swipe your debit card, the bank earns interchange fees from the merchant. Even pending transactions become a source of income through something called float, where banks temporarily hold money before payments officially clear, allowing them to profit from millions of transactions happening every day. But it goes even deeper than that. Your spending habits, purchase patterns, and financial behavior create valuable consumer data that can be analyzed, packaged, and monetized. In other words, your money is not the only product inside the banking system, your behavior is too. The uncomfortable truth is that banks are designed to extract value from nearly every interaction you have with them, often in ways that feel invisible because they've become normalized. And once you see how many profit channels exist behind a simple checking or savings account, you begin to realize that modern banking is not just storing your money, it's building an entire business around your financial activity. Fair, people like Jordan are not financially clueless. In many ways, they are already ahead of the average person. Jordan saw that traditional savings accounts were paying almost nothing, so he moved his money into a high-yield savings account earning around 4.5 fund trum. Compared to the 0.38 fund trum most banks offer, it felt like a massive upgrade. For the first time, his savings actually seemed to grow. Instead of earning a few dollars a month, he was earning hundreds per year. And psychologically, that matters. It creates the feeling that you finally understand how money works, that you've escaped the trap most people stay stuck in forever. Jordan did the research, compared rates, and made a smarter decision than millions of other savers. But that's also what makes this next realization uncomfortable. Because even though the numbers improved, the system itself never changed. The bank was still using his deposits to generate even larger profits behind the scenes. Jordan wasn't outside the machine, he just had a better seat inside it. And that's why high-yield savings accounts feel so powerful. They solve enough of the problem to make most people stop asking deeper questions. The problem with high-yield savings accounts is not that they are bad. In fact, for many people, they are far better than traditional savings accounts. The real problem is believing they are the final step towards smarter money management. Most people see a 4.5 fund term APY and assume they fully optimized their cash, but the reality is often more complicated. Some banks advertise promotional rates that only last a few months before quietly dropping. Others use tiered structures where only a small portion of your balance earns the highest yield, while the rest earns far less. And even when the rate is legitimate, taxes quietly reduce what you actually keep. Federal taxes, state taxes, and inflation all eat into those returns in ways most people never calculate. But the biggest issue is deeper than the percentage itself. The bank is still acting as the middleman. Your money is still being used to fund loans, treasury purchases, and other investments generating profits beyond what you receive. The only difference is that this time, the bank shares a slightly larger portion with you. That's why this matters so much. You're getting a bigger slice, but it's still only a slice. The system hasn't fundamentally changed. The bank still controls the flow, keeps the largest share of the upside, and profits from your capital first. High-yield savings accounts feel like financial freedom because they improve the numbers enough to stop most people from questioning the structure behind. This is where most people discover something the financial system rarely explains clearly. You do not always need a bank to earn yield on your cash. One alternative is Treasury bills, short-term debt issued directly by the US government. When you buy a Treasury bill, you are essentially lending money to the government for a few weeks or months in exchange for interest. Another option is SGOV, an ETF that holds short-term US Treasury bills and allows investors to access them as easily as buying a stock. Instead of letting a bank take your deposits, buy treasuries, and keep part of the return, these options let you access that yield much more directly. And that changes the entire perspective. Suddenly, you realize the bank was never creating the yield in the first place, it was simply standing between you and the underlying asset. There are also tax advantages many people never hear about. Interest from Treasury securities is generally exempt from state and local income taxes, which can make a meaningful difference depending on where you live. More importantly, the system becomes transparent. With a high-yield savings account, the bank controls the rate and can change it whenever it wants. With Treasury bills, yields are tied to real government auctions and market conditions. You can actually see where the return comes from. And for many people, this becomes a revelation moment. Not because Treasury bills are some secret path to wealth, but because they expose how limited most people's understanding of cash management really is. The biggest shift is psychological. Once you realize you have options outside the traditional banking system, you stop viewing banks as the only safe place for your money. At this point, most people immediately think about safety. A savings account feels secure because it's backed by FDIC insurance, and that protection is real. If a bank fails, deposits up to certain limits are guaranteed by the government. But Treasury bills are also backed by the US government because they are direct government debt. In other words, you are not moving from something dangerous into something reckless. You are simply changing the structure of where your cash sits. Another common concern is liquidity. People worry they might suddenly need access to their emergency fund, and that's fair. But options like SGOV can typically be sold quickly during market hours, with funds settling in a short period of time. Realistically, most emergencies do not require instant access to tens of thousands of dollars within seconds. The goal is not to eliminate convenience, but to understand the trade-offs between convenience and long-term efficiency. Once people understand that, the fear usually becomes much smaller than they expect. The deeper lesson here is not that banks are evil or that savings accounts are scams. Banks are businesses, and like every business, their goal is to generate profit. The real issue is that most people go through their entire lives without ever asking what their money is actually doing once it leaves their hands. They focus on working harder, saving more, and being responsible, but rarely stop to understand how the financial system itself operates. And that lack of awareness changes everything. Financial literacy is not just about knowing definitions or memorizing investment terms. It changes behavior. Once you understand how money flows through the system, you begin to think differently about risk, opportunity, debt, and even savings itself. You stop accepting financial products simply because they feel familiar or safe. You start asking better questions. Why is the bank willing to pay me this rate? How are they making money from my cash? Is there a more efficient way to hold my money? That shift in awareness is where real financial growth begins. Because in the end, wealth is not only built by earning more money, it's built by understanding how money moves when you are not paying attention. Personally, I don't think high-yield savings accounts are bad. For many people, they are still a huge improvement over traditional savings accounts paying almost nothing. If moving your money into a HYSA helps you become more intentional about saving, that's already a positive step. But I also think the bigger problem is something deeper. Most people spend years working hard for money without ever learning how money actually works once it enters the financial system. We're taught how to earn, how to budget, and how to avoid debt. But almost nobody teaches us to ask where our cash is sitting, who is using it, and who benefits from it while we sleep. And once you start understanding that, your perspective changes. You stop blindly accepting financial products just because they feel normal. You start asking better questions. Personally, I don't think the goal is to obsess over squeezing every extra dollar from your savings. The real goal is awareness. Because awareness changes behavior, and behavior changes financial outcomes over time. At the end of the day, the difference between someone who stays financially stuck and someone who gradually builds wealth is often not income, it's understanding. So here's the question I want to leave you with. If your bank is making significantly more money with your cash than you are, should you still call it your money?